Thanks for joining David, Kevin, and myself for the market update for the month of August. For all of you that have kids going to school, we hope you had a fantastic summer and hope they enjoyed their first day back at school. What's going on in the market? We really saw a lot of a tug-of-war in the month of August. At the beginning, we continued on with the positive trend that we had in July, and then Powell came out and gave us a real hawkish speech about being hard on inflation and hard using interest rates to continue to control them. And it kind of spooked the market a little bit, and we definitely saw a negative trend after that. The US market was off about 4%, Canada was off about 1.6%, and Europe was also off for the month of August. We're going to have David and Kevin talk about the cases for a bull market and the cases for a bear market. So I'm going to be off to you two now.
Thanks, Harry.
David, what are some cases for a bull market at this juncture?
Well, there's a few, Kevin. The first is that a swift slowdown in inflation is expected. Some of you listening to this may think that's delusional just based on the fact that everything still feels quite expensive, but on a comparative basis, there is indications. The most recent data is showing that inflation is indeed slowing. The Atlanta Federal Reserve keeps track of an index called the Fundamental Inflation Index, or they refer to it as the Sticky Inflation Index, which basically removes energy and food prices from inflation data. And that index is now, most recent reading is showing an annualized rate of inflation on their quote-unquote sticky index at 2.5%, which is in line with historical averages and the lowest reading it's had since September of 2021. And on the more volatile side of inflation, energy and food prices have actually seen a more marked decrease in the most recent reading. Those two inputs, energy and food prices, have decreased 11%, a little over 11%. In the most recent reading, which is the lowest since April 2020. So there is evidence that it's starting to, these interest rate hikes are starting to impact inflation, and we're starting to see it slow down. It's obviously still early, and as we know, energy and food prices are quite volatile. The war in Ukraine and energy supply in that region is volatile, so we'll have to see how that unfolds, but at least for the sticky inflation, which excludes food and energy, it is seemingly coming down. Also, the labor market may be softening a little bit. It's again still a little bit early for data here, but it seems like job openings are starting to slow, and people who and employment is still remaining robust. So people who have jobs now currently are remaining in their positions. Companies aren't slashing their workforces. And so if we can see job openings per unemployed worker start to come down a little bit and wage increases start to normalize a little bit, that would be a good indicator for a stronger economy and a bull market taking shape. Also, consumer sentiment improvement. Right now, consumer sentiment, or in recent months, consumer sentiment has been really low, near historic lows, and so typically it can only improve from those lows. Also, the U.S. consumer is in relatively good shape. U.S. household balance sheets, so the U.S. households' debts to assets are in a good position, better than they have been in a long time. In Canada, it's actually a little bit worse compared to the US. But the US household's in a good position. And as long as we can start to see inflation start to roll over a little bit, which again, early indications are showing that's happening, and we can see that the workforce remains, or unemployment remains relatively low, then we should start to see consumer sentiment improve quite a bit. And typically, historically, when consumer sentiment has been as low as it is currently, typically 12-month forward returns for the stock market are quite attractive. So we don't know for sure that that's going to happen, but historically that has been what's happened when consumer sentiment is as low as it is now. Kevin, what might be some bear indicators or for the market right now?
Yeah, so The Fed has shown that it's inclined to risk over-tightening monetary conditions in an effort to bring inflation back under control. As a result, expectations for interest rates to keep increasing rose quite sharply in August, close to the Fed's projections. And should these projections materialize, U.S. monetary policy should indeed be in a restrictive territory by the end of this year. Now, this is synonymous with inversions of the yield curve, which in turn are synonymous with recessions. Now, case in point, since 1970, the last 8 U.S. recessions have been preceded by indicators measuring the depth of the yield curve inversions. Now, we haven't passed that critical threshold yet, but it's beginning to seem more and more like a formality. Also, the Conference Board's leading economic indicators, which takes 10 economic and financial measures, including the yield curve, has passed a threshold which has preceded every U.S. recession over the last 5 decades, with no false signals. The only other recession indicator with a flawless track record, to my knowledge, is when the U.S. 3-month average unemployment has risen more than 1/3 of a percentage point above its recent lows. Now, there's nothing to report on this front, but here lies the rub. The 3-month average unemployment is far more useful at confirming that a recession has already started than it is of warning of one's imminence. For instance, since 1970, the unemployment rate has signaled the start of a recession on average 3 months after one has already began, compared to 4 months in advance for leading economic indicators and 12 months in advance for the yield curve. As far as asset allocation goes, should investors be making any changes at this point?
It's a good question, Kevin. As always, nobody knows exactly what's going to happen for the stock market or the economy in the short term. It's very difficult to say over the next 3 or 6 months what's going to happen. And so as always, we recommend being properly diversified, but we can't ignore the fact that some leading economic indicators have certainly turned yellow, if not red at this juncture. And so it's probably prudent to be a little bit more cautious with your asset allocation, especially if you're investing some new money. You may want to consider carrying a little bit elevated cash levels, perhaps being a little bit underweight equities over the next few months as we see just how far interest rates are going to have to keep going. As we see more economic data come around, has inflation actually started to roll over, and will that trend persist? Because once that happens, or if that does happen, that would be a good indicator for the economy. But we're certainly not out of the woods yet in that regard. And so definitely diversification makes sense. It doesn't necessarily mean that we need to make wholesale changes to one's portfolio, but just being a little bit more cautious over the short term, the next 3 to 6 months probably makes sense until we get a little bit more direction on just where the economy is headed. Are we already in a recession, or has one already begun? That should become clear in the next 3 to 6 months. Now, it's also important to recognize that even if we are already in a recession, or one does in fact get called and one occurs over the next little while, the stock market doesn't always mimic exactly, stock market activity doesn't exactly mimic the economy. A lot of times the stock market is 3 to 6 months ahead of the economy in terms of pricing things in. And so obviously the first half of 2022 has been a difficult one because the stock market has been forecasting that the economic conditions are getting worse this year. And so they may continue to get a little bit worse. The economy may actually fall into a recession. But there's a very good chance that the stock market actually looks past that pretty quickly. The stock market may say, okay, well, if recession's here, the Federal Reserve may now pivot on interest rates, and we'll start to see interest rates plateau, if not maybe start to come back 6 to 12 months from now. And then the stock market can kind of start to look beyond that, especially if inflation starts to roll over and if unemployment doesn't creep up substantially. So as always, being diversified makes a lot of sense, not making total wholesale changes to your portfolio. But if you know that you have some short-term needs coming up, carrying a little bit of extra cash probably makes sense at this point in time.
Yeah. If you ever have any questions, feel free to reach out to Harry, David, or myself at any time. Thank you.
Take care.